Good morning and welcome to TOI Japan Market Radio, coming to you from Tokyo on November 28, 2025. I'm your host, and this is your daily briefing designed specifically for global investors tracking Japanese markets. Today we're going to walk through the latest market action, policy signals, and what it all means for your Japan exposure.
Thanks for having me. Let's start with where we closed today. The Nikkei 225 finished at 50,253.91, up 0.173%. TOPIX gained a bit more momentum, closing at 3,542, up 0.312%. The Mothers Index also pushed higher, up 0.424% to 2,130. J-Rights were the laggard today, down 0.796% to 2056.0. On the currency side, dollar-yen is sitting at 156.119, down a modest 0.077%. Elsewhere, gold in yen terms rose 0.772% to 15,655, and crude oil gained 0.408% to 59.08. So broadly speaking, we saw a risk-on tilt in Japanese equities, with the yen holding relatively steady.
That's a solid overview. Now let's dig into the key themes driving these moves. The headline that caught a lot of attention today is the Nikkei's rally extending on speculation around further Federal Reserve rate cuts, even as Tokyo inflation data came in hot. This creates an interesting tension for Japanese policymakers and investors alike. Can you walk us through what's happening here?
Absolutely. What we're seeing is the market pricing in expectations that the Fed may have room to cut rates further, and that's generally supportive for risk assets globally, including Japanese equities. At the same time, Tokyo inflation data released today showed that domestic price pressures in Japan remain elevated. This matters because it complicates the Bank of Japan's policy stance. On one hand, the BOJ has been extremely cautious about tightening too quickly given the fragility of the domestic recovery. On the other hand, persistent inflation makes it harder for them to justify keeping policy ultra-loose indefinitely.
So we're in a situation where external conditions, namely Fed easing expectations, are supportive for Japanese equities, but domestic inflation is creating a potential policy constraint. How should investors think about the near-term impact on the Nikkei and TOPIX?
In the near term, I think the Fed narrative is the dominant driver. Lower U.S. rates tend to support global risk appetite, and that's clearly benefiting Japanese stocks, particularly exporters who get a valuation boost when U.S. yields come down. We saw that today with the Nikkei pushing above 50,000 again. However, the upside could be capped if the BOJ is forced to signal a more hawkish tilt in response to inflation. That would weigh on rate-sensitive sectors like financials and utilities, and could cool some of the cyclical momentum we've seen. So it's a tug-of-war between external tailwinds and domestic policy uncertainty.
And staying with the yen theme, how does this Fed-BOJ dynamic play out in dollar-yen?
The yen is likely to face continued weakness in this environment. Fed rate cut expectations typically encourage carry trades, where investors borrow in yen to invest in higher-yielding assets elsewhere. That dynamic tends to keep the yen under pressure. Today we saw dollar-yen relatively flat at 156.119, down just 0.077%, but the broader trend is still tilted toward a weaker yen as long as the Fed narrative holds. That said, if the BOJ surprises markets by turning more hawkish on inflation concerns, we could see a sharp reversal. The yen remains highly sensitive to any shift in BOJ rhetoric.
On the policy side, what about Japanese government bond yields? How are they responding to this inflation data?
We're likely to see upward pressure on JGB yields, particularly at the longer end of the curve. Elevated Tokyo inflation suggests that the market will start pricing in a higher probability of BOJ policy normalization, even if it's gradual. That pushes yields higher. At the same time, if the Fed is cutting, that creates a bit of a counterforce, but I think the domestic inflation story is more important for JGBs right now. So investors should expect the 10-year JGB yield to drift higher in the coming sessions, reflecting those domestic pricing dynamics.
Let's shift focus now to what's happening in the United States, because that clearly has spillover effects for Japan. Wall Street is gearing up for a week focused on artificial intelligence developments and key economic data releases. U.S. equity markets have been stabilizing, and there's a lot of attention on corporate earnings updates and macroeconomic indicators. Why does this matter specifically for Japanese investors?
U.S. market momentum is absolutely critical for Japanese equities and yen dynamics. When U.S. equities are stable or rising, that generally supports risk on sentiment globally, and Japanese stocks benefit from that environment. Capital flows into emerging and developed markets outside the U.S. tend to pick up, and that includes Japan. Additionally, the AI theme is particularly relevant for Japanese semiconductor and technology companies, many of which have significant exposure to U.S. tech supply chains. If AI sentiment remains positive in the U.S., Japanese tech names like chip equipment makers and component suppliers should see a tailwind.
And on the currency side, does a stable U.S. equity environment have a direct impact on dollar-yen?
It does. When U.S. equities are stable or rising, risk appetite is healthy, and that tends to support dollar strength against the yen. The yen is a safe haven currency, so when risk is on, investors tend to move out of the yen and into higher yielding or growth-oriented assets. That dynamic reinforces the carry trade positioning we talked about earlier. So a stable U.S. equity backdrop is generally yen negative, or at least it prevents the yen from strengthening materially.
Shifting back to equities, are there specific sectors in Japan that benefit most from this U.S. AI and tech focus?
Definitely. Japanese semiconductor equipment makers are the most direct beneficiaries. Companies that supply critical components to U.S. tech giants, or that are part of the AI hardware supply chain, stand to benefit from sustained investment in AI infrastructure. We're also seeing interest in Japanese robotics and automation companies, which are leveraging AI to expand their product offerings. More broadly, any Japanese exporter with significant U.S. earnings exposure benefits when U.S. economic data remains solid, because it supports demand for their products.
Now, there was also some concerning news out of global markets today. Reports came in of a significant trading system outage that disrupted global equity markets, and this contributed to stocks being positioned for a monthly loss. The technical failure affected trading operations and created volatility and liquidity constraints across major exchanges. How does something like this impact Japan?
This is actually a pretty significant issue for Japan, even if the outage didn't directly hit Tokyo Stock Exchange systems. Japan's financial markets are deeply integrated with global trading infrastructure. When there's a disruption to international trading systems, it impairs the ability of Japanese institutional investors to execute cross-border trades efficiently. It also affects real-time price discovery for Japanese equities and index futures that trade on global exchanges like Chicago and Singapore. There's a risk of pricing disconnects between the Tokyo Stock Exchange and offshore markets, and that can create confusion and volatility.
So even though the outage may have been centered elsewhere, the ripple effects can still hit Japanese markets. What should investors be watching for in terms of market impact?
A few things. First, if the outage extends into Asian trading hours or if it dampens global risk appetite more broadly, we could see downside pressure on the Nikkei and TOPIX. Reduced trading volumes could also increase volatility, making it harder to execute large orders without moving prices. On the currency side, if this outage triggers a broader risk-off move, we could see the yen strengthen as investors seek safe haven assets. Flight to safety flows tend to support the yen, especially in an environment where liquidity is constrained. And for JGBs, we'd likely see yields decline as investors pile into Japanese government bonds as a defensive play. There's also a risk of technical dislocation if the outage affects JGB trading mechanisms directly, though that seems less likely at this point.
Meanwhile, in corporate news, or rather in the broader market structure conversation, how prepared is Japan for these kinds of technical disruptions? BOJ has had its own issues in the past.
That's a fair point. The Tokyo Stock Exchange experienced a significant outage a few years ago, and since then they've invested heavily in system redundancy and resilience. But no system is completely immune to failure, And the interconnectedness of global markets means that even if Tokyo's systems are functioning perfectly, disruptions elsewhere can still create problems. Japanese institutional investors rely heavily on algorithmic trading and automated risk management systems, and those systems depend on continuous data feeds and execution capabilities across multiple markets. Any interruption can force manual intervention, which is slower and more error-prone. So this is something market participants here are watching closely.
Let's bring it all together now. For global investors who are either invested in Japan or monitoring their Japan exposure, what are the main themes to take away from today's session?